Welcome to episode 10 of the Tax Update series. I'm your host Andy Rainford, Chartered Tax Advisor, content writer and editor here at Tax Essentials for Advisors. It's dreary and drizzly here in North Wales, but my vegetable patch is grateful at least. In this episode, we look at the rumours circulating about more tax hikes in the forthcoming budget, a new opportunity for those with simple assessment debt, and ponder the meaning of life. Sort of. The 2025 autumn budget will take place on the 26th of November. This is relatively late, which came as a surprise to some commentators. It seems likely that we will see more tax increases, though as yet there is little to suggest the government's election promise not to raise income tax, national insurance or VAT rates will be abandoned. Of course, the rumour mill is in its customary overdrive mode. Let's look briefly at some of the more persistent stories. Could national insurance be applied to rental profits? This would seem like an easy political win, but would likely have a knock-on effect on rent levels, in a similar way that the employer NI hike has affected pay rises and vacancies. Possibly less open to backlash is the suggestion that potentially exempt transfers might be capped. Currently, an individual can give away as much of their wealth as they like with no immediate IHT consequences. A cap would likely see amounts above a certain threshold treated as a chargeable lifetime transfer, taxable at the lifetime rate. Salary sacrifice can still be effective in some circumstances, for example, pension contributions. Perhaps that's why I've read that a cap on the amounts that can be sacrificed effectively may be on the way. Sticking with pensions, and another rumour is that the 25% tax-free lump sum may be further restricted. This already has a cap based on the old lifetime allowance, but with IHT coming on pension pots in 2027, the government may feel this is a natural next step. Land taxes are also popping up in online commentary, with suggestions that council tax and stamp duty land tax could be replaced with more modern equivalents. Usually I advise people to treat budget rumours with a pinch of salt, but recent years have seen several policies enacted that were badly kept secrets in the run-up, so you never know. An interesting story concerning Deputy Prime Minister Angela Rayner came to light in the last few weeks. Ignoring the predictable political mudslinging, what actually happened? Well, the controversy surrounds whether or not the Deputy PM should have paid SDLT at the higher rates on the purchase of a property near Brighton. The law is that an additional 5% should be paid if the buyer has a major interest in another residential property. Rayner had received advice on the basis she did not have any other interest, having sold all of her share of her constituency property to a trust set up for the benefit of her disabled son. However, because of his age and her role as trustee, she should have paid the higher rates, which she realised after taking specialist advice. I think the key takeaway here is to ensure all relevant details are given when asking for advice on such matters. It's not clear whether the initial advisor was made aware of the trust structure. If not, then a carelessness penalty could well be added to the additional SDLT charged. The latest advisory fuel rates for mileage in company cars have been published. Most of the changes are minor and apply from the 1st of September, though the old rates can be used until October. More interesting is the introduction of a second tier of rates for electric vehicles. The relevant rates will now be 8 pence per mile for home charging and 14 pence for public charging. The full rates can be viewed at the following link. In further HMRC news, taxpayers that have debts that arise through simple assessment can now apply for a time to pay arrangement online instead of having to phone HMRC. This can be done via the self-service part of the online account, and applies where the debt is at least £32 and not exceeding £50,000. So on to cases. First up, does a company have life? In this case, a company settled money into a trust. Following the 10th anniversary, HMRC issued a determination to collect the 10-year charge from the company. However, it appealed on the basis that the law specifies that the settler is liable where the transfer is made during the life of the settler. As the settler was a corporate entity, it didn't have a life, and so the provision couldn't apply. The tribunal easily dismissed this argument, saying that it was highly doubtful that Parliament intended to use the word life in a restrictive way that excluded corporate settlers from the charge. Let's end with a win for the taxpayer. Mr. Masters partook in Tesco's defined benefit pension plan. In 2016, he transferred the cash equivalent to a self-invested pension plan. He later moved to Portugal and made withdrawals from the plan. The double tax treaty means that pensions and similar payments made in consideration of past employment are only taxed in the country the recipient resides in, Portugal in this case. However, Portugal has a favourable tax break to attract immigrants that means these payments are taxed at 0%. HMRC tried to argue that the payments lost their character as being in consideration of past employment because Masters had transferred the entitlement to a SIP, so the double tax treaty didn't apply. The tribunal disagreed, noting that if Masters had simply withdrawn the amounts directly, they would have clearly been related to his past employment. Right, that's it for this week. Don't forget our next webinar on inheritance tax on pensions is on the 11th of September at 1 p.m. The link to register is in the description. This is completely free to attend and will provide you with some valuable tips to prepare for the changes. Until next time, it's goodbye from me.